we're going to break some new ground here. We have never talked about taxes at the Tactical Trade Investor Forums. Normally, it's just, okay, everyone trades futures. You're at a 60-40 split between long-term, short-term capital gains. Section 1256 is our friend. But we've had a lot of people actually ask us tax questions lately, so we thought it would be good get some experts on here. So we've got Maurice Berkhauer from Berkhauer LLC. We've got Bob Enck, who's the CEO of the U.S. Gold Opportunity Zone Fund. And we've got Philip Gross, who is an attorney at Kleinberg Kaplan Tax Department. So they are going to regale you on what the changing presidential administration may, not necessarily, but may lead in tax law changes across opportunity zones, Green New Deal. Is that going to happen? And will there be any changes to 401ks? So everybody is in good hands right now. Maurice is having a little bit of a tech issue. So Bob, do you mind kicking us off?
Yeah, I'd love to. Thanks. Thanks for having me for starters. And the area of kind of the go forward, what's going to happen under a Biden administration and so on that I'm most expert in is opportunity zones. So why don't I give a quick overview of what opportunity zones are, talk a little bit about what that means and how you may want to adjust what you're doing now based on what we think might happen, okay? So in the 2017 Tax Cut and Jobs Act, opportunity zones were created and formed. There were a couple years there it took to get the opportunity zone legislation done, updates, refinements, and so on. And so it really took till the end of 2019 till there was great clarity on how they work. But here are the simple highlights. The government has provided tax incentives for investors to put money into economically depressed areas, okay? They call them opportunity zones. There are 8,700 of them around the country. Every state, there's a lot of discretion at the state level as to where they would be and so on and so forth. But net is, why would one want to invest in an opportunity zone, all right? Really simple, taxes. So the first order is that if you roll gains in, if you roll in capital gains from any other source just about, okay? Stocks, real estate, what have you, you roll it into an opportunity zone investment, which could be either a qualified opportunity fund or an opportunity zone business, okay? You roll in a gain, you get to defer the payment of your federal capital gains taxes until either you redeem or 2027, okay? Think about that. You roll in a gain, you defer paying capital gains taxes. There's a couple other areas within that, and I want to come back to these later as there's discussion about how these may change going forward. But to the extent you roll in a gain and you keep it in a qualified opportunity fund, for example, for 5 years or more, you get a 10% step up in your basis. So not only are you deferring, you're getting a step up in your basis, okay? Perhaps more importantly, especially if we think capital gains taxes are going up, and I'm guessing we're gonna have some ideas around the table as to are they or not, okay? Or how much are they going up? But if you keep an investment in that opportunity zone fund, in that fund itself, or your investment in a opportunity zone business, you completely eliminate capital gains taxes. So in our world, here's what we've gone through. And we created an opportunity zone gold fund, okay? And within that, there are a lot of rules and there's a lot of likely rules that will be added that you kind of have to foresee. I'm going to talk about a couple right now, and then I'll turn things back over to Maurice now that I see that he's on. But net is this: under the rules, you need to demonstrate that you're driving economic activity in an opportunity zone. So as you look at or consider opportunity zone funds, or QOFs as you'll hear them called, most of them are real estate. Most of them are not very interesting, but if you like real estate, it's a more tax efficient way to get in real estate. We chose to go into gold, but here are the simple things, and I think others will have to do it. we started the business, started a new company in an opportunity zone. So instead of being here where I'm right now in downtown Princeton, we in a week are moving over to a opportunity zone in Bristol, Pennsylvania. We're having all of our service providers, all the major service providers will service the fund out of an opportunity zone. All right. We're also part of the investment thesis is, we're buying and selling gold, physical gold, bars. Okay. And with that, we're going to be moving the bars of gold from outside an opportunity zone to inside an opportunity zone. And why would we do that? Why? Because all the economic activity that goes with that, right? The storage, the security, the weighing, the assaying, all the kind of things you have to do where groups like Brinks have built a business around this. We're going to be moving that to an opportunity zone. So you look at other things, administrators, lawyers, auditors, they're all going to be servicing this out of an OZ. And why are we doing that? Because if you look at what Biden is talking about doing, if you look at the kind of bipartisan support that you might have with like a Senator Tim Scott, Cory Booker, all of them are talking about tracking this and documenting more driving economic activity in OZs. And so, we've already put it out there that on a quarterly basis, we're going to track this because, you need to make sure that you see where the puck is going. I heard the hockey players talking, so let's have a Wayne Gretzky reference here. But let's go to where the puck is going and not to where it is. All right? And that's going to be more tracking. It's going to be, are you really complying with the spirit of the opportunities in legislation? The last thing I'm going to say on this part is that we all know that there's some uncertainty with legislative changes, okay? I mean, for example, who's going to win Georgia? We can come back to that in a bit. I have ideas on what that means. But one of the key things you may want to think about is liquidity. If you're unsure what is going to happen next year or the year after, one of the things you may want to have is flexibility on liquidity. So, you have opportunity zone funds that allow you to defer taxes. You have opportunity zone businesses that allow you to defer the payment of capital gains taxes. But the question is, do you want to, should you be locked in for the long haul? I mean, I think, yes, I expect capital gains taxes are going up. So if yesterday a post-tax investment in, let's say, gold or something like that was attractive, if taxes are going up, something that's tax advantage is going to be more attractive. But that said, I'm going to give you two references that I think might be helpful for people. And don't fall over on your seat, Maurice, when I say this, but the IRS website, the IRS Opportunity Zone Frequently Asked Questions website, that webpage is actually pretty good, okay? It is absolutely positively worth looking at if you're thinking about OZs. Also, we have put a ton of information on our website with this, which is as simple as can be. It's goldozfund.com. Think of it as a resource. There's a ton of information. So now that our esteemed moderator is in action here, I'll turn it back over to you, Maurice, and be ready for anything you might want to throw out.
First of all, thank you very, very much. And my apologies for the technical difficulties that I had a few moments ago. And I don't know if Phil Gross was adequately introduced to the public yet. So if he hasn't, let me do that. Bob, I think, did a very nice self-introduction. Phil is the chairman of Kleinberg Kaplan's tax department. He's been advising fund clients and other clients since 1993. He provides advice on federal issues, state issues, international issues, private funds, hedge funds, private equity, real estate, etc. He's a long-term colleague of mine, and we see each other many, many occasions. He has written numerous articles and made numerous presentations. And not only do I consider him a valuable colleague, but as well as a valuable friend. I wanted to ask you one question, Bob, which is something I did ask on Sunday when we spoke Sunday morning, is that although it is early in this whole opportunity zone concept that President Trump put together, but do you believe, or are there any studies that what the social aspects or the what I'll call the social aspects of the opportunities intended to provide jobs, to provide opportunities for those in the lower class. Has that been achieved? Has there been any studies on that?
Yeah, there's a lot of early kind of references to it. And depending on where you look, I see a lot of different answers out there. But let's start with a couple big numbers. The expectation was that there was going to be $10 billion in year one and $13 billion in year two invested in OZs, okay? Best number I can find so far, there's been $75 billion of private capital invested in qualified opportunity funds. 75 billion, okay?
Right, I understand that, but has the 75 million in part generated more jobs, more opportunities? Has it done that?
Yeah, well, some of the other data that you see out there. So you'll see the White House reports that prior to opportunity zones being created, that the home values in these opportunity zone locations were declining significantly, right? There are steady declines. There were, you know, these are rough neighborhoods. I've been to a number of these, especially as we went to find real estate for our office. Subsequent to the legislation being enacted, the average home price now has gone up 1.1%, right? So there's some anecdotal data there. The other one is, but you're really asking a question that we think is coming down the pike, right? If you look at the groups, if you look at, let's say, Tim Scott and Cory Booker, what are they kind of getting together with? What do they want to ask next? What did Biden put on his website? What is he talking about? Everyone wants to track economic activity. So what we're going to do, and what we think is pretty easy to quantify, how many jobs have been moved from outside to inside. You know, for us, at the service provider level, we're going to be trying to track quarterly FTEs, right? I mean, you know, if we're starting with Brinks, for example, in an opportunity zone location near JFK Airport, you know, you're moving gold from outside to inside. You're going to have people managing that. On our side, you know, we're going to be putting people, actual jobs, seats in an opportunity zone. And, you know, when we go to lunch, guess where we're going to have lunch? We're not going to drive back to fancy neighborhood. We're going to go around the corner. So there's a lot of really specific, fairly easy tracking. We're going to do it quarterly, but it looks like the request for the next layer of potential legislation is like a once-a-year report to say what kind of activity you're driving.
Okay, thank you. I didn't get a chance, obviously, at the beginning to talk about what we are going to talk about, is what's going on as a result of the election, and very, very significantly.
Maurice, can't hear you.
You muted yourself.
Maurice,
Muting.
Better. No.
you're still muted. You're muted, Maurice. So,
Am I okay now?
You're good.
Okay, sorry, my apologies. No matter what, we're right now in a very, very tenuous situation, because there's a big election or a big runoff taking place in Georgia. Right now, obviously, as everyone knows, if either one of the two Republicans win, the Republicans will control the Senate. If they do not win, the issue will be a 50-50 split with the vice president-elect Kamala Harris getting the deciding vote. Interestingly enough, and it's something that Phil and I had spoken about for a few minutes yesterday, there's a key Democratic senator from West Virginia, Joe Manchin, who really, really holds a lot of control right now. And should there be a 50-50, you know, you can walk into President Biden's or President-elect Biden's office and say, hey, listen, you got to take care of me because I can just vote now with the Republicans and we can stop everything. I don't know how strong he is or whether he's going to do that, but something that we have to think about. So consequently, all of us ourselves as someone who prepares and advises clients on taxes. Phil, in the same situation. What do we tell our clients? They're asking questions. What do I do? What do I do today? What do I do now? I've always philosophically feel that we should deal with what our decks are here now. These are the rules today. However, we need to think about what the rules are going to be tomorrow. And I actually had asked someone from my staff to run a little bit of an example on what would be the effect on a Biden plan versus a Trump plan in the following two scenarios. Scenario one is a single person wage earner who only gets a paycheck of $500,000. What would be the difference under Biden and under Trump, knowing that Biden wants to raise the income tax rates, and in addition to that, he wants to assess a social security tax on any wage earner above $400,000. So under the Biden plan, compared to Trump, there's about approximate $9,000 increase if you were earning $500,000 single person. And Phil, I want to hear your thoughts on this upcoming one. If you were self-employed, under Biden, is he getting rid of QBI, which is the qualified business income deduction?
He might. I mean, no one knows. So, but there is a potential that the 20% deduction goes away, at least for people above like 400. If you're seeing that number.
So, if a self-employed individual earning 500 under the Biden plan versus Trump, that particular person's tax will go up by $46,000, which is a significant amount. So I think a lot of this has to be factored into hopefully the Senate as well as the Congress as to really what the effect is. This QBI has been a very, very, very positive tax effect for a lot of entrepreneurs to put them on even keel with the federal corporate tax. So if he's going to increase the federal corporate tax from 21 to 28, maybe he'll give a little effect to a QBI at a 28 versus a 21. No one really knows. I think maybe a good idea now to just spend a few minutes and going through some of the tax proposals under the Biden plan, and I'm going to switch it over a little bit to Phil to take over for that part of it. I'll interject, don't worry.
Okay, well, I think the first thing, really the immediate thing that people need to consider is what to do over the next couple of weeks, if anything. And this is kind of evolved over the last 2 months or so. What tax planning do I need to do before the end of the year? And initially in November, people said, oh, no, there's going to be all Democratic sweep. And so was going to be actually more concrete steps taken before the end of the year. There's not a sweep, and we might not know until January 5th or later who wins in Georgia. So there's been a little bit less like concrete tax steps taken, when people are betting like, will there be a change? If so, what will rates go up? Will they go up 1/1/21? Will they go up 1/1/22? So I think the biggest thing on most people's mind is what to do now. I think a lot of people, the majority of people, think that maybe the Democrats don't take both seats. Who knows? Or if they take both seats, maybe they can't rely on all 50 Democratic senators, or that Biden will have to focus on the economy on COVID and won't get to taxes anyway until 1/1/22. And I think that's probably the majority of folks that think the latter, that there probably won't be anything until 22, but no one knows. So big thing, what to do now? And this year reminds me of 2012 a little bit, because 2012, we knew actually rates were going to go up in 2013. Here it's kind of different. We don't know that they're going to go up in 2013. So there's a little bit less concrete steps people are taking. And we'll get into details what rates could go up. Obviously, they could go up substantially. But I think,
Phil,
sure.
quick question. Do you think Biden will hold off a little bit since there are actually 3 more Republicans up for re-election in 2022. You think he's going to crapshoot and hope they lose?
No, no one knows. Yeah, I don't know. You know, I wish I knew. I'd get paid a lot more money, but no, I don't. But I think planning for the end of this year is really clearly, if I have state and local tax deductions or real property tax deductions, pay them next year. Don't pay them this year. So pay them in January rather than December, because at least next year you have a shot that state and local tax deductions come back or at least are increased.
Yeah, well, let's stay on the state and local, because I think there's a lot of activity going on in certain states of this country, which I think everybody should just be aware of. There are about 7 states that have enacted what's called the pass-through entity tax. Principally, I'll just go quickly through the states: Connecticut, Louisiana, Maryland, New Jersey, Oklahoma, Rhode Island, and Wisconsin. And the pass-through entity tax is actually very, very viable. The IRS has said this is allowable as a workaround toward the lack of the state and local income tax deduction that was removed. And it enabled those individuals to live in those states with a proper structure for a partnership, an LLC, and an S Corp to basically pay a tax in those states and get a federal income tax deduction as well as a credit on their state personal tax. We've been doing this for our Connecticut clients, and it's been working out extremely well. New Jersey just passed it this year, which is another major blue state. So I think anyone who resides in any of these states or is thinking of moving out of the socialist states of California and New York and into a state that is more entrepreneurial should consider moving either to a state that has a pass-through entity tax or a state that just has no income tax. So very, very important. And also we're thinking about advising our clients who have the opportunities to go from a Schedule C, self-employment, to create a partnership entity, or even if you have an investment with your wife and separately a joint tenant, just pool it and create an entity. So these are opportunities to work around this state and local income tax. And I'm not so sure the state and local income tax ceiling that was at $10,000 is ever going to come back and be allowed as an itemized deduction. What do you think?
I agree. I think it will increase, but I don't know when. It won't go back to all, but we'll see. But there's clearly a lot of state and local planning. And the other thing I would do for, at least for the end of this year, there's 2 other things potentially. One, if I was gonna sell something in January or February anyway at a gain, I'd probably sell it this year. At least I know what the rates are this year, and they could still go up next year. And the third actually ties into a little bit what Bob was talking about, is there's a lot of flexibility where you could do something this year, sell something at a gain or sell something at a loss, and kind of undo it depending on what we know next year. Maybe more, January 6th, we might know, okay, maybe I should have realized that gain or I shouldn't realize. But for example, opportunity zones gives you flexibility. You have a big gain this year, you might decide to keep it recognized in 2020 or kind of roll it over in the opportunity zone, I think, by next year's tax returns. Like you have some months next year to see what happens next year, whether roll it over. And there's a lot of other techniques like that. You could violate the wash sale rules on purpose, realize a loss this year, and then undo it because you think it'll be worth more next year. You could do constructive sales this year and undo them next year. So there's a lot of potential planning. We have a lot of people that have done the constructive sales, and there's different ways. There's a constructive sale rule set forth in 1259 of the code, but there's other ways to effectively do sales and undo them early next year. There were a bunch of different ways. So when I was thinking about it, that to provide you a month or up to like 8 months into next year to undo it. So that's one thing. Once we get into next year, the planning is what do you do next year? Because when we know more information about what might happen on taxes, do you move to another state? Do you invest in an offshore corp to try to, again, either save state and local or delay federal taxes until you know what they are and rate The other thing to consider, I guess another thing people are doing this year a lot, which is estate tax planning. Because the thought process is, one, it's at very low interest rates anyway, although I don't see them going up anytime soon. There are a lot of estate planning techniques you can use in a low interest environment. And two, right now it's about $23 million that you and your spouse can give to your, can give away estate and give tax free. I think most feel that will go down. Again, I don't know whether it will go down next year, or whether it will go down to 5 million or 6 million or 3.5 million. And estate tax rates are projected to go up. Again, we don't know, but if we have people that have a lot of money, clearly they should use up the rest of their unified credit this year. And I get a lot of the same people are very busy, so it's actually getting really late in the game to do that. But that's another thing. If I'm worth $50 million, I'm going to use up my 20 million this year or whatever to give away. And how I give it away is to take some planning and some time, but that would be something else to do this year.
Do you think that the Senate will compromise? Do you think? I mean, are we seeing potential that there will be some compromises, there will be cooperation, or is this going to be a Senate that is going to just tell Biden no way? Should they win?
I'm not optimistic yet, but we'll see. Hopefully I'm optimistic. I know and I'm never political. I know I come at it a little bit differently than you. So I don't know.
Yeah, it would be very, very, very interesting to see if there's movement between the parties. Bob, I think I interrupted you. Go ahead.
Well, I simply wanted to clarify one item that Phil had thrown out, which I think is an excellent point. Okay, talked about you have some time to decide. So 2 areas on this. So from the time that you execute and recognize the capital gain in another investment. So let's say you sold a building, and to the time you roll it into an opportunity zone to get the tax deferral, you have 180 days, okay? So to the extent someone in the audience has realized a gain in the last, less than 180 days, they still have that opportunity to roll it into an opportunity zone to defer taxes. Secondly, within that, if you're doing what Phil's talking about right now, right? You recognize the gain now, decide next year what you want to do with it. You'd have to do it in the first half of the year because you will have 180 days to deal with it. Okay.
And there is a partnership. If you're a partner in a partnership, and the partnership realized it, I think any time this year you still have that 180 days from the end of this year. So you have time. Depending on where your gain is, there's potential of longer deferral.
Yeah, there was some clarifications, I think partly due to COVID, to try to give people extra time if they, recognize gain early this year, and they extended that. But I think if you recognize it between now and the end of the year, you're going to have 180 days. I don't think there's an extension next year.
No, I agree with that. He's meant if it's through a partnership or not. Might be different. But and as far as specific tax changes, Maurice, there really are the proposals are out there. I mean, as far as really substantially increasing individual income tax rates, doing away with the cap on Medicare above $400,000, that alone would be huge. I can't imagine that being enacted. But if they did that, plus some of the rates they were talking about, you'd have like almost a 56% federal tax rate. Plus, if you add on that a 12%, let's say, state and city tax rate in the city, you're talking 68%. So there's no way I see that happening, but there are.
But isn't that a lower tax rate than Bernie and AOC are proposing? Aren't they going for 80?
It's a lot lower than the tax rates were in the 70s, and and before that there was like a 70% or 90% tax or something.
Before I was born, I don't remember that.
But no, so the rates could go up substantially, whether for individual or for corporate, or whether it's just, or even for capital gains, whether they take away, tax capital gains as at the ordinary income rates. That affects the fund industry as far as the carried interest.
Many. There are probably a lot of alternative structures that could hopefully come in to help mitigate that. On the corporate side, with the corporate income tax rate going from 21 to 28, Number one, just economically, what has happened in the last several years, did the reduction in the corporate rate from 34 to 21 help the United States or U.S. corporations? Were there a lot of, we certainly know there was a lot of inflow of money when they converted to GILTI, but is the United States in a competitive environment with the rest of the world at 21? Or will 28 bring them into a non-competitive environment? Any ideas, any thoughts on that?
Not really. That's more of an economist. I don't know if there's enough of the data yet to say what one way or the other. I don't know that. I think 28% is the feel like it doesn't offend people so much from 20, like going back to 35% would. So I wouldn't be surprised if it does go to 28%. Whether economically the U.S. has worked out better, I think you have to compare it with the rates and other tax changes that were done as far as GILTI or deductions that they added to the code. So it would be hard to say. I don't know. Presumably, obviously, I think the obvious answer is if it's less, it helps the U.S., but I'm not certain it has.
Right.
Yeah, I think this is a no-brainer. I think it's so clear. And you have patterns that are going on right now. How many hedge funds are moving from New York to Miami? How many big companies are moving from California to Texas? Big noteworthy companies moving to Nashville or, Tennessee. You see the tax policy drives behavior of businesses big time, right? It's huge. Goldman Sachs, I think this week was talking about moving their asset management business to Florida. Well, why would they do that? Obviously, because there's no state income tax there. It's more tax friendly. In our business. So, prior to us launching U.S. Gold Opportunity Fund, I was CEO of Equinox Funds, and we allocated to commodity trading advisors. So we're very friendly, get to know many of the large hedge funds, and we saw them all the time move to countries where they could negotiate their tax rate. Why are there so many in Switzerland? It's tax. So we see it firsthand. If corporate taxes go up, that is a deterrent for companies to stay here or get founded here when they have other options.
Okay. Well, there's a lot of the cost of operating in the United States, particularly again under a socialist mentality. The cost to operate in the United States continued to increase. Again, I don't want to sound like I'm a right-wing individual here, but I think we have to consider how this country grew, and it's grown under opportunities, and we should provide those opportunities to continue. Phil, I wanted to bring up something that didn't come through on some of the notes that I put together, but isn't there some talk about taxing unrealized gains as well?
There's been some proposals more at the state level to tax unrealized gains. I don't give that a shot of being enacted, but there has been proposals. I think this is where Cuomo's right. If they're really wealthy people, maybe they do move out. But I don't think you can tax unrealized. I think there's some question whether it's constitutional. And second, from a practical perspective, unless it's publicly traded stock, you can't really value it that easily. So I don't see the states enacting that.
And I think by taxing unrealized, you're moving closer to what Elizabeth Warren proposed, and Bernie proposed, which is a wealth tax, because that's really what they're proposing, is on taxing on unrealized. And I can't see this country, and I don't see anything that Biden has put together that he wants to enact a wealth tax, which has been a dismal failure in the European countries. Do you think that ever going to happen?
I don't think that will happen. I think they could. There's a lot of things that they could be done for estate taxes or gift taxes to tighten up the transfers, but I don't think the taxing on income tax on unrealized wealth would be taxed.
Right. Do you see changes really in any of these other states? I mean, none of the states that have a state income tax, they're ever going to give that up. And in fact, in some of the initiatives, some of the ballot initiatives on the states where the Democrats, because they were the blue states, but they did turn down a lot of state increases, particularly California, Illinois. So I think the people are just resistant to tax increases. And maybe the government has to listen to some of the people.
The states are in
Possible?
agreement. We'll have to see what happens with that, whether they get federal government.
Listen, even de Blasio listened to the New York City parents who wanted the kids to go back to school, which is amazing in and of itself. There's a lot of focus on climate change and things of that nature, the Green New Deal, monies to be allocated for that. What do you see? Do you see that we're going to enact, or Biden is going to try to push through major tax increases so that everybody can go carbon free?
I think there will be a lot of incentives enacted to go for the, to become more green and to become more climate friendly. So it might be that shifts, what good investments are, what companies will do, even relax on the ESG. Some of the paper, some might see in the paper that the Department of Labor came out and said that it didn't favor ESG. So you couldn't have a pension plan that invests in ESG just because it was ESG. You had to document why it was just as good an investment. I think some of that stuff will be relaxed under a Biden government, and also there will be more incentives to switch to climate-friendly technology.
Is anybody on Biden's team that are potentially business-friendly, tax-friendly, or is this a totally left-wing conspiracy?
It's getting too political for me, but I'm a tax guy. I'm not a political person or that, so I don't know that. I mean, we're happy to speak again. There's a bunch of different potential tax planning to do again by the end of this year and next year, just to monitor what to do. And to the extent state and local taxes remain non-deductible, there's a lot of different ways to plan to effectively make them deductible. As you mentioned, I would expect that Cuomo had some really good proposals a year or so ago, 2 years ago, to deal with state and local taxes and moving them to the business level. I think that will be done. I'm surprised it actually hasn't been done. Just since there's a recent notice about a week, it's only a week or two ago, I guess, but I still think I would have thought proposals would come out really quickly on that to enact.
At home to us as New Yorkers, why wouldn't New York have put in a PTE? You would think that would be a major they revenue producer too. But I know they started, but they stopped.
That this wasn't enacted, and then it was one like 20 or 30 years ago too. But they do have to. They'll have to do that very quickly. Very,
very to be competitive, even. Of course, if you're sitting in between Connecticut and New Jersey, people will just say, you know what, I may as well take some advantage and move out of the state.
That's right. So, around here, I'm in New Jersey, and the exodus to Pennsylvania is at the high end of the market. I mean, and the acceleration, you guys were talking about the $10,000 deduction, really basically the SALT deduction. Around here, it was remarkable to me how much that accelerated relatively comfortable folks around here in Princeton to make sure the residence was in Florida, right? And also, Maurice, I think we all know, everyone on the call knows that the big sweeping changes that could happen, right? The Biden proposals and, you talked about, AOC and Bernie and so on. But if any of the big changes are coming, it's all about Georgia, right? If the Republicans get one of those seats, I think it'll be very difficult, and, Phil, it doesn't matter what side you're on. I think it'll be very difficult for the big sweeping changes to hit if Republicans get one or both of those seats. If the Dems get both of them, I think it's likely these big changes could hit. So, Yeah,
it's all a matter of prediction. Everyone could agree that if Republicans take at least one of those seats, it's going to be harder to make tax changes.
Yeah.
Even if the Democrats take both, I think some of the tax proposals out there are just too far reaching. I don't think they'll do that. But I think there will clearly be some increase. And there's got to be. Look, they can't run the economy with such a huge deficit. So something's got to give on that.
Eventually. Yeah, I mean, also what I've been hearing from a number of investors or fund managers who kind of sort of believe that with Biden, there may be some stability and that the markets may not tank. What are your feelings on that?
Again, I'm not an economist, so I don't know, but I mean, that's the same thing that the market's actually increased since Biden won. So I think there's some truth to that. And there's some investments that might go up more if they're in the green, if they're climate change industries or certain industries, technology will still go up. It's very hard to predict on that.
Mm. Bob, any more money going into opportunity zones this year? Think so?
Yeah, I think a couple things. It's people have had a chance to let the rules digest and understand the rules. And so you start seeing things like more liquidity in opportunity zones, right? So you can take advantage of the deferment, stimulate job growth in OZs. And I think it's still coming in pretty heavily. That said, the sophistication of this has just gotten better. I think people popped out some real estate funds that were kind of kludgy, difficult to liquidate and so on. And I think the products have just gotten better. I mean, our opportunity zone gold fund, if you like gold, I mean, we priced it the same as the largest ETF in terms of 40 basis point total fees. So I think you're going to find that because the products are getting better, that more dollars will come in. And let's face it, it's the same kind of thing that we're talking about with the corporate taxes. If you're, if there's more businesses being based in the United States and they're not going away, I would rather have these assets managed in the United States than overseas. I mean, one of the things that we see is that the large ETFs store almost all of the gold overseas. It's stored in London. So seeing tax legislation, bipartisan support tax legislation like OZs that can say, look, manage those, oversee that in the United States, and specifically in an OZ, that's nothing but good, nothing but driving jobs in the United States, which, so I think you'll see more dollars going to OZs. And on top of that, let's face it, regardless of what's going on politically, ESG is a wave, and it's a big tidal wave still coming, right? And there's a lot out there in terms of the environmental part, but there's not a ton in terms of the social part. So I think you'll see OZs fits that social bucket, and there's a lot of interest in doing more ESG investing.
All right, thank you. I want to thank Bob and Phil for being on the panel and joining us, especially Phil last minute. And thank you, James, for providing this opportunity for us. Hopefully people got something out of it, and thank you very much.